Hello, I'm Julia Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using CME Group event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, and copper. Today, we have a great show for you. Instead of interviewing a guest like I normally do, I'm going to share my favorite trade setups using gaps and wicks. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading CME Group event contracts. That's what we're all using at Place Your Trades. Over the next month, we are giving away a trip to Las Vegas. One winner will join the PYT team at the Money Show on April 24th to 26th. All you have to do is go to placeyourtrades.com/Vegas and sign up before March 1st. On March 1st at 4 p.m. Eastern Time, we will have a special show for you, and we will spin the wheel to see who wins the trip to Las Vegas. So exciting. Okay, today, the reason I decided to do this is because I have found through trading so many years, my own very specific gap setups, and I find them to be very high probability. So I figured, why not share them with people? The only thing that I would ask in return is if you see one of these setups, just please let me know so I can trade it with you because they are very high probability. Okay, so let's start off by looking at a real life example. So first of all, what is a gap? A gap is when there is an empty space between the close of one candle and then the high or the low of the next candle. So here you can see on this gold 4-hour chart, it was consolidating, right? It was moving into in a triangle. Was it the cleanest, most beautiful triangle? No, it was not. Anyway, I mark off gaps pretty much on all my charts. And the reason I do it is because if price action comes back to that, and it doesn't always come back to gaps, but if it does come back to that gap is usually support or resistance. So in this particular case, there was a fakey breaky, so to speak. Not really, because it didn't close outside of this triangle, but there was a big wick here. Clearly, especially within consolidations, when you see a big wick, it usually means momentum is going to shift the other direction, at least for a little bit. But in this case, so price action came back and filled this gap once, and then it closed back outside of this gap. That's bullish, right? Usually, yes. But in this particular case, it came back and filled the gap again and closed back outside of the gap again. What that did was it took all of those weak bulls here. It made a slight lower low, and it basically got them out of the trade, right? So I call this a double dip gap fill. I think this is extraordinarily bullish. It almost always means that there's going to be continued price action to the upside. And because this was such a beautiful consolidation, I was pretty confident that not only would we see a large move because of the size of the consolidation, but that large move would be to the upside because of this double dip gap fill. What? I know. So let me show you something else that is the opposite direction. This is a double pop gap drop. So I marked off this gap in copper. This gap was from the beginning of June. This is the weekly chart. And I thought, you know what? Who knows whether it'll come back to test it or not, but if it does, let's see what happens. Same exact thing happened. So in this particular case, we came up, we filled this gap, and then closed below it. So the exact opposite, right? So now this gap is resistance, came up, couldn't get above resistance. The next candle filled this gap again, but then closed below it. Now it's not the most beautiful thing because you don't see the wicks here, but it's the same thing because we closed below it. So basically we have two candles here that have completely filled the gap and closed below it. And then price action for some period of time was down, right? Right. So that's my first setup that I freaking love, double gap fills. It's the best, in my opinion. Let me talk about my next setup. Okay, so this one is when you see an exact bounce or near exact. We're talking about within a couple pennies or so off the top of the gap. In my experience, this kind of gap does not, it is kind of when the gap is support, but it bounces perfectly off the top, it almost always means that it's going to come back into that gap and at least do a partial gap fill. So for me, that's good for a short. So I look to fade any kind of exact bounce off of the top of a gap or off of the bottom of a gap. So, and by the way, I know I'm sharing these, in hindsight, right? I'm not saying, hey, this is a setup right now, but I wanted just to prove to you that I'm not just saying this. This is something that I said in real time. I did a write-up on it that basically the same thing, right? This candle here is this candle here. And I'm basically saying, look, I'm going to fade it, at least initially, because like I said, it doesn't hold. So bounces off the top or the bottom of the gap are, in my opinion, good to fade from. So what else? I've got something else on this exact chart. Now, it did come into this gap and did a near gap fill, right? I would say, what is that? It's a little more than 3/4 of a gap fill here. So I call this a near miss gap fill. And so basically what I'm saying here is that if there's a gap fill that closes back outside after a near miss, then at least you will get continuation to the upside, at the very least, in my opinion. So that's what happened here as well. So near miss gap fills that have larger wicks, in my opinion, are great to momentum trade with. Even though it's like, well, it closed, it's okay. That's what I feel as well. So basically 2 different tricks off of the same exact chart. And so let me just summarize here. I'm going to go back to my handy dandy slides. And okay, so these are my favorite gap setups. Number 1, double gap fills. Both candles must have filled the gap and closed outside of it in the same direction, then trade in the direction that they close in. So basically, if 2 candles fill a gap that is at resistance and then close below resistance, that is short-term bearish. If both candles fill a gap that is at support but close above support, that is short-term bullish. Now, the next one is near exact gap touches. That is when price bounces off either the top of a gap from above or the bottom of a gap from below. Almost always, if it touches that gap just a little bit and then bounces from it, then that gap is going to get a partial or complete gap fill. So I will then trade in the direction accordingly. Near miss gap fills. That is when you get almost a complete gap fill, but not quite, but then have a large wick getting you outside of that gap. That to me is really strong short-term momentum. I still, however, mark off that little partial gap that's yet unfilled because, again, that could come in useful for us later as support and or resistance. Okay, so that's it. I want to thank you so much for joining me today. I hope this was helpful to you. Please let me know when you see one of these setups so we could trade it together. And I wish you the very best trading this week. Please follow me, Cordova Trades, on Twitter, as well as Place Your Trades. And I will see you on the interwebs. Okay, bye.